Hello, ladies and gentlemen, and welcome back. Well, we've now hit it over 5%, in fact, upwards of 5.2% expected Federal Reserve terminal rate in the US for 2023. This means interest rates are going to go a lot higher. And on top of that, we've got markets closing on their daily lows. Does this mean that we're potentially moving to some of our worst case scenarios, the 3,200, 3,250 area, or even lower on markets over the next subsequent weeks and months? Well, we've got the data covering stocks, commodities, and cryptos right now. Join us as we talk about everything under the hood for markets around the world. Well, welcome back everyone to the Daily Show. We'll start off here with the macro data, then we'll go into the lead indicators, and of course we'll be covering the key levels that we should be watching right now in the main markets. US 30-year versus 3-month yield spread. Inversion has occurred. You'll notice that there's only really two other times that this has happened heavily, and both have been significantly prolonged bear markets, those ones that go between 12 and 18 months. Now, remember, we are still not even 12 months into this yet, so that could mean a little bit more pain is to come on the horizon based on these inversion spreads. When we're talking about recessions, though, and realistically now we're 90% plus according to the market chance of recession, I think that word is overblown. We're already seeing a lot of punishment in the markets due to that. What we should instead be looking at is whether we've seen PE compression, or at least valuation compression. The recent retracements for the S&P 500 have been in one of the top 6 since 1954, more records broken by 2022. And you'll notice here their top S&P 500 PE ratio drawdowns. This is one of the biggest on record. Now, it still hasn't made it back to the drawdown that we saw during the 2020 crash. And that's something that we may be looking for. A lot of people want to see pre-highs for 2020, and that's where they think the market may bottom off. Let's talk about what asset managers are doing though. Are asset managers net long or short? In recent weeks, they've started purchasing again, but they're still incredibly short overall. And what that means is they've been buying at a way slower rate. Traditionally, this has been that kind of area where you start to look for value in the markets. Remember, if asset managers are purchasing at a very slow rate, it means that the sentiment is incredibly negative. When they get overly optimistic, you need to be paying a lot of attention to that. This really goes back to that Buffett concept of buying, of course, fear and selling greed. If we take a look now at the leveraged money, what's going on? Well, leveraged money throughout this rally has been re-shorting the market. That is that they reduced their shorts on the way down, and since it's been going up, they've increased their shorts. Now, I like to follow leveraged money. We will be doing it here over the next coming weeks in the market to see what they're doing. But at this stage, they continue to stack shorts against this market, but they're not as short as they were once before. Now, also, have we actually seen a turnaround in asset management purchases that's significant? Well, you'll notice here that we hit kind of a high around the middle of August. That was where we peaked off. Of course, it makes sense. Who's moving the market? It's not us, the retail traders alone. It's generally the composite man or the bigger managers out there. They've since, of course, reduced their purchasing, and they're back on a little bit of a buy strike. I don't know whether we can call this a base yet. I mean, if we see asset managers going above these levels, potentially we could say, okay, there's more rallies to come, or at least we could be seeing a base in the market. That certainly has not been happening, but we will report on it should it occur. What about dumb money versus smart money? Is that inverted yet, or at least gone backwards with each other? No, we haven't quite seen dumb money and smart money do the conversion. Now, usually when dumb money overtakes smart money, we need to be looking for further shorts. It hasn't quite happened yet, and it is something that we'll be following, but it's damn close. And that's why these shorts recently have made so much sense to us. Remember, we were talking about this heading into the FOMC statement that the market was most likely going to short. It has, and it's continued since then over the last 2 days to close on its lows. The only thing that can save it now is the big news ahead, the non-farm payrolls. Will that turn the market? NASDAQ Composite quarterly loss streaks. Yep, again, we're back in really, really extreme territory. Basically, we're at 33% down for the NASDAQ. As you would know, when we look at it later, it's near its lows again. And this is the market that's generally been the lifeblood of America. Innovation. It's one of the biggest things that makes us love the American market so much. What about spending? Well, it's starting to hit the pockets of everybody around the world. Of course, staples making up a bigger portion of people's expenditure in comparison to discretionary buying. This is basically demand destruction underway, and it's what the Fed's trying to achieve. And we can already see it because, of course, what are we seeing in XLY, the consumer discretionary sector? Everyone is effectively dumping it. The market doesn't like it because they see real issues over the potential next year to 2 years when it comes to people demanding goods and buying discretionary objects. What about earnings per share? Well, it's still not down. The consensus for 2023 is still quite high, actually. And you'll notice the historical average, we're not even underneath it yet. Now, in previous times, we've usually seen further drop-offs in earnings per share. So we should be seeing this continuously drop now in terms of expectations forward for the street. We're in earnings season, and frankly, it is not very good. And it shouldn't be. The whole point is that basically now we should see PE contraction, and that's what's happening during this earnings season. All the big tech stocks came out. They didn't meet the expectations, and the market's rotating into defensive sectors while rallying those and, of course, dumping big tech. Industrials, energy, staples, healthcare, financials, they've been the most favored kind of sectors in recent weeks, especially in earnings season. And I just want to remember and go back to this quickly. If we are going to see yields go to their highs, usually the 2-year yield peaks 1 to 1.5 months before the end of the cycle. This is something that I think is really important, and we should always discuss it. At this point, the actual Fed terminal rate is pushing out. So at this point, we could be seeing a rate hike in around June or July as of the last 24 hours. It's constantly changing, but we still need to remember 1 to 1.5 months before is the average. Is seasonality working? Yeah, theoretically, yes. Bear markets generally tend to start selling off at the beginning of November. That is what we've seen so far, followed by some sideways action kind of at the middle to end of November into December. So that's something we could be looking for. As we mentioned, earnings season is bad. 63% beats 1,018, misses 607. Nothing really to look forward to there. It's probably what you have to expect. Not good earnings season. Technically, it's what the Fed wants, what should happen, and markets should, of course, compress for that. We still have some earnings moving forward this week, but most of the big ones are out of the way. A lot of disappointment throughout most of those earnings, realistically, and the stocks have felt the brunt of all of those things. Let's jump into the charts now. What about the VIX? So a lot of people are confused. They say, well, shouldn't the VIX be going up? We're seeing a lot of volatility in the markets. We're still stuck in the same range. So what that means is that if the stock market makes a new low, expect the VIX to go up very heavily. If the stock market, even if it's going up and down 3%, was in the same range it's been previously, the volatility can still drop. Remember, 25 VIX is still very high VIX. That's an incredibly volatile market. This is where all the action was over the last 24 hours. Look at those 2-year yields spike, 4.7 to almost 5.2. Wow, that's a huge pump in spiked literal levels for these interest rates. If we go to the 10-year, you'll notice even that went up to 4.15. And if we scroll over, this is where the damage was done. April 2023, 5.04. But this is the one, September. Check this out, 5.11%. That's saying that there is potentially another miniature hike starting to get priced in between April and September of 2023, followed by a miniature cut now in the end. So it kind of looks like this. Originally we had this and we just flatlined. Now it kind of goes up and then potentially just drops that amount by the end of 2023. That's basically now accounting for almost no rate cut in 2023. The Fed have really scared the market with some of those things that have been said, and non-farm payrolls will become important because of this. High yield bonds hated the session as well. We did see some rally through the back end, but realistically they fell off. No new lows on high yield bonds, so it's following the SPX. Now remember, these have been disconnected. So if we see high yields go to a low and the stock market's not in a low, that generally tells us it's an early warning sign we need to be paying attention, we need to be careful. We also had that DXY, the US dollar, just strengthen and strengthen and strengthen. And actually, I've left these zones in here just because we want to talk about them. We didn't see turn here. We saw a miniature turn in this zone. And these were the 2 levels of supply that we had in the previous market video. yeah, you can prep it, you can set it, but if you don't see the turnaround trends, what can you do? We're now entering into that major level of supply for the US dollar. And what I'll do is I'll set a little alert just underneath this low, just in case it does happen. And then of course, I want to be looking at the structure of how it's turning so far to see whether if rallies are going to be met by sell demand. Let's move over to the euro, take a look at that one. This did actually hit into a very nice demand zone. It completely busted off this. You'll notice it dispersed, which was one of the scenarios, and then just sold off. That sometimes does happen. And then the market's come down to this previous wiki zone and finding buyers at this stage. I don't think I like what I see so far. There was probably a trade. If you got into the buy side over here, you may have been pretty happy with yourself. This rally into this supply made sense. At this stage, it could very easily be distribution into a new low. So be very careful out there. We haven't really seen enough price action to really make any differences. And remember, we have non-farm payrolls coming. So we have supply up here, which we know because it consolidated then dropped. So if non-farm comes out, there also could be a spike up here followed by a dump. You've got to be very aware of this 98.20 to 98.30 zone on the euro. With non-farms, 1 hour before the market opens, this is the jobs number for the US, expect spikes of key levels. Gold did a little bit better. Gold's moving on up as much as it can off that previous demand level over here. And we've seen, the only reason I think this is happening is because if you look at it, we had such strong purchasing twice. That was 1 and 2. So at the moment, it's a 3. It's going against the US dollar a little bit. It's doing the best it can. Again, non-farm payrolls will be the number. And if we go up, where could we find some resistance? Somewhere around that 1638, we could find some resistance. Potentially there's sellers there. And if it busts that level, pullback should be met by bull demand. We'll talk about that on the weekend video. Non-farm payrolls, again, will completely change this market and probably give us quite a lot of opportunity for the next week. US oil continues to hold these lows. It did close above the previous supplies, which we mentioned in the previous video. That's overall a kind of positive sign. Again, yields going up as well. The 2-year, the September yield, next year, the curve in general, that is usually traditionally good for oil. So oil may do well, but yeah, I think it's still temporary. My longer term aspect is probably some demand destruction. A lot of people will disagree with that. So far, I've been correct. We'll find out whether it makes any differences. Now, that doesn't mean you go in short like energy stocks. Of course, they're getting loaded by previous price and the market's getting euphoric on those ones. I'm talking about spot oil in this case. So this is the chart I'm looking at this stage, mostly bullish on the shorter time frames. Not much to hate there just yet. Let's move over to some stocks and start talking about the stock market. Tesla held amazingly well, 215. It really didn't get punished. I've still got the 180 as a potential landmine. We'll talk about that more as we go through the other stocks, but it's still in the consolidation. Volume is, I guess you would say, consistent. It's not extreme. There's not as much purchasing as there was over here, let's say. But yeah, look, it closed mostly negative. I don't think that Tesla's really controlling this market. Here's one that is though, and that's Apple. Now it's left behind a fairly decent gap, so maybe it can come back and then sell off that 140 zone, 144, I mean. That area could become a sell, but watch out for new lows for Apple. Remember, Apple effectively is the biggest stock in the market. It really pushes around sentiment. And at this stage, it's been drop, and it's currently in and around this previous demand lows. So it could find a rally here if the non-farms number is favorable to the market. But others are not showing that. Microsoft, new low. This is a great stock. One of my favorite in the world in terms of Microsoft over the long term. And you can see it's dropped significantly. Like that's a big drop off, new low. And I'm just going to put some on the charts here. Google, look at this one. Wow, new low, just getting absolutely thumped. And these are fearful times in these particular markets. Have they found their lows? Well, Google is getting close to the 2020 highs. And remember, if you have traded Google for a long time, it didn't really do that much since 2018. So we're now, let's say we take the peak over here, we're only about 29% up if we bought it over here at those peaks. And yeah, I mean, it's starting to get into that zone. We will do a multiple test, is when we'll go through some of these stocks and see whether they've compressed enough. But the market is fear selling these. It's also fear selling anything to do with consumer discretionary. Ads and consumer discretionary is getting thumped. And you could see Amazon quite easily getting down into these 81s again. What a massive turnaround. I mean, the whole COVID thing's not been bad for Amazon, but clearly multiple compression. And you just have to, in these types of times, you just have to make money. And Amazon's not really fronting enough cash, I guess, for the market's expectations. Dow Jones versus S&P 500. This is the chart that showed us that we have not got a healthy recovery. We have a weird recovery. The old economy. That's what's doing well. So the old economy, the Dow Jones, the industrials, all these types of things are completely destroying the SPX. And of course, if you put the Dow Jones versus the NASDAQ, the outperformance is even more extreme. This is something you haven't seen for a while in markets. Basically, we've had a bit of defensive movement, of course, in 2022. Makes sense that the Dow would beat the other markets. It's more defensive, the old economy. But yeah, traditionally, it's been going on that downward slope in the last couple of years. So this is some severe outperformance. Usually that cannot hold a market. So industrials can't usually hold and push a market. I would see most likely some kind of turn in the future on this. But again, the DAX shows the same thing. Although the DAX is at our trend line, it's holding amazingly well. Again, tech is what's being sold. This reminds me of the start of 2022. You know what we're talking about. Tech was just getting belted. Everything else was like, yeah, pretty much flat or green. This is the weird thing about inflation and the way that we're seeing this stagflation. It's PE compression on high multiple stocks, except for Tesla. That's like a random one. That seems to be doing its own thing. But yeah, the DAX here, you can see a little potential double top, and that's starting to form. And you'll notice it actually broke to the low here. So again, you kind of got that peaking, and we've come down. Potentially, we're now looking for further shorts on the DAX off this level. Ultimately, the American market will show us this. The Dow was going so strong, it came into the trend line early. That was also a supply zone previously, and we've seen sell-off. Another day close to its lows, but the Dow did see some buying near the end. What didn't see buying was the S&P 500. Here's the weekly. So I just want to talk about these levels. So we've got unfilled gaps down here at 35.82. Potentially a zone that the market may want to come down to at least. And then we have previous gap issues that are in these market lows. And of course, that 3,250, something that so many people want to go back under the 2020 highs and to really just take off everything that was put on in the pandemic. It's very possible that that is going to occur. If we go and have a look at the daily close, which I think is super important, we end up closing as on the real market as a bit of a doji, on the futures market on its low. So the doji tells us that there is an equilibrium in this market. Effectively, yeah, it's sold off. It's not sure on the next move. Does it want to go bullish? Does it want to go bearish? Maybe the market doesn't even know which one it wants to do. But often if you make a new high or you make a new low, that can trigger to those next levels. And we'll take a look at that soon. But yes, the bearish close showed us that any rally was going to be met by sell demand in the next session, and that is what occurred. Let's move to the NASDAQ now, just to show how bad the performance is on the NASDAQ. A lot of people, unfortunately, will be hurting out there due to this one. We never saw the NASDAQ make that new high. It just kind of sat there and stuffed around. It's now close to the low. So I could see some people trying to rally it again. We haven't got the signs yet that that's occurring. But it is right on that previous daily close level. And this is going to be a pivotal zone. Ultimately, non-farm payrolls will move this market. And if it chooses to rally, it's going to be very quick, I would think. And then still, at this stage, rallies should be met by sell demand. And that's what you're looking for. Now, if the NASDAQ does fail again, the next level would be 10,400. And underneath there, then we're starting to talk about pre-pandemic kind of highs around that just 10,000, maybe even 9.8. We'll do that, and we'll cover that when it's time to do so. Let's have a look at the US 500. Let's look down into the hood. So far, it has been mostly sell-off. We do have some key levels. You'll notice I've got an alert above this high. If non-farm payrolls does come out and it bounces, there could be sellers right here. So what we'll do is we'll box that zone because I think that's a very important level that we need to be focused on. We'll actually box it to that previous green candle. So that's around the level we would expect. And the market could easily do this and then this. Now, why have we got 36.77 on the charts? That's the most traded level throughout this range. So because that's the most traded level throughout this range, it's kind of like an equilibrium for the markets, and the markets may wish to come down. Now, the reason why we say that also is if you look at this daily close for the futures market, it doesn't look like a long leg doji. In fact, it's closed close to its lows, but there's still a wick that's coming up. So again, this is very possible. The market dropping into this kind of POC, finding this base here, this previous daily close is super possible. So I'll mark that as well, just so we have it. And if I was looking for buys, I would most likely be looking in here for potential turnaround stories. And I would be looking in here for potential short stories if I was day trading this, just as a potential. Yeah, they're the kind of levels. Where the gaps are, well, there's gaps that go down all the way into that 35.82 that still haven't been filled. So there's a gap down there. But the market is not showing us that it wants to rally yet. In fact, it's mostly bearish across the board. And a lot of stocks like Microsoft, Google, Amazon are showing us that more pain could certainly be around the corner over the next coming weeks. That's not normal how they've been dropping, and they're just basically in free fall at this stage. So rallies probably met by sell demand. Let's move over to the options. Does this all make sense? Well, options are very interesting. Here's the Friday expiration. You'll notice that we still have those 360 puts sitting there and a little bit of 370. Current stock price is 370. The market may say max pain. We're not in the third week, so we don't need to worry about that too much. But somewhere in here is probably where you'd expect the market to close. Between 360 and 370 would be a pretty good level for the market to close off the week. We'll find out where it ends up doing it. And of course, on the weekend video, we'll take a look at the big options expiration in November. So definitely join us for that. Bitcoin is doing way better than I expected. It's still holding this demand zone. We haven't triggered the alert low. So at this stage, it's still theoretically bullish. Remember, Bitcoin is effectively in a Wyckoff schematic. A lot of people are looking at this as accumulation, and this component is what they call the SOS. If it fails here and we end up getting a drop, rallies should be met by sell demand. And if that happens, it kind of shows us the entire economy around the world partially is pretty sick. And if we end up getting a new low, which we've got an alert here, I could see this become capitulation. That is maximum fear, a drop off, kind of like that pump meme. He bought and then it just goes, dump it. It goes through. Unfortunately, that could be the reality of when if this market does do this particular thing. We do expect crypto potentially to move like it did last time. Negative 83 to negative 86% is the average move down during crypto winters. We are not there yet. That would be between 11.5 and 9.5 in terms of just averages. And it should happen theoretically before February, at least in terms of the data I've done. And I will release that soon. Let's move over to the calendar. What's moving forward? Yep, it's this one. Non-farm payrolls, the unemployment figures. Ultimately, we want weak numbers coming out of the US. The market will probably like weak numbers. It's a weird world we live in. Terrible news is good news. Good news is bad news. And I would expect yields to move a lot in today's session. I would also expect, of course, the markets to react fairly heavily to this number. This is not really the time to be a scalper. You can set, levels that you think might be extreme zones, but you've got to be very careful out there, guys. These two bits of news together will have a big impact on the next subsequent weeks because they're just that big to the economy right now. If you haven't already, come and follow us over on Twitter. Of course, you can follow the handle at FX Evolution. You can join our public Discord community. And do remember, if you're interested in finding out more about some of the things we do over at FX Evolution, some of our courses and things like that, you can jump on over to www.fxevolution.com and have a look over there. Also, of course, you can read some of the reviews if you're interested. Thanks so much for watching, guys. Remember to subscribe, smash that like button. We'll see you in the next video. Good luck today.